Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include tariffs and the most recent government actions, my interview with Angel Oak's Tom Hutchens on the impact of the Fed's rate cuts on mortgage activity and the potential for increased demand for non-QM products like HELOCs, and the Fed-favorite core personal consumption expenditure price index is out today. Are you looking to deliver a complete digital mortgage experience? Look no further than Be Smarty. Be Smarty delivers world-class digital mortgage technology for banks, credit unions, and non-bank lenders. A true digital mortgage platform improves your consumer and lender experience, reduces costs, and reduces cycle times. Learn more at besmarty.com. The overnight news focused on yet another round of tariffs. With a packed economic calendar yesterday, data took center stage in influencing investor sentiment, though. Q2 GDP was revised up to 3.8% from 3.3%. Durable orders grew unexpectedly in August. That's 2.9% versus negative 0.5% expectations. And weekly initial claims decreased to 218,000. The combination suggests that the economy is holding up well, but does complicate hopes for multiple rate cuts before the end of the year. Separately, existing home sales dipped 0.2% month over month in August to a seasonally adjusted annual rate of 4.00 million from an unrevised 4.01 million in July. Sales were up 1.8% on a year-over-year basis, still constrained by high prices, higher mortgage rates, and limited supply. The biggest month-over-month increase in sales was in the Midwest, which is also the region with the lowest median price. And the Treasury posted a weak $44 billion 7-year note offering, helping to flatten the yield curve. The White House told federal agencies to prepare for possible mass firings if the government shuts down next week. Yes, changes are afoot. U.S. federal housing, that's Fannie and Freddie, has formalized its withdrawal from the network of central banks and supervisors for greening the financial system, or NGFS. In a letter to the chair of NGFS, U.S. Federal Housing Director Bill Pulte wrote, quote, Biden drove housing costs up with politicized nonsense that prioritized climate activists over American families. Consistent with President Trump's executive orders, we are removing these distractions to ensure Fannie Freddie and our housing finance system stay laser focused on delivering the American dream of homeownership. End quote. In a letter, the agency states that employees will no longer engage in NGFS committees, task forces, or working groups, and further requests should be removed from the NGFS website and other public materials. We also learned yesterday that mortgage rates ticked up from last week's lows, which were the lowest since last October. For the week ending September 25th, the 30 and 15-year mortgage rates in Freddie Mac's primary mortgage market survey rose 4 basis points and 8 basis points, respectively, to 6.30% and 5.49%. They remained 22 basis points and 33 basis points higher from a year ago. For today's interview, I wanted to welcome back to the show Angel Oak's Tom Hutchens to discuss the impact of the Fed's rate cuts on mortgage activity and the potential for increased demand for non-QM products like HELOCs. He's president of Angel Oak Mortgage Solutions, a non-QM wholesale lender that prides itself on innovative solutions for underserved borrowers.
For the longest time, people in the non-QM space that were championing it were saying it's great, things are going great, blah, blah. And people that weren't intimately involved in it, myself included, were kind of going, yeah, well, it benefits you to say that. I'm going to say I've done a 180 now. I've come around. I've seen the light. I've drank the Kool-Aid, whatever terminology you want to use. But it seems like non-QM is booming and here to stay, and there's investor demand, and it's all timed so well with Fannie and Freddie kind of receding from market dominance. It's timed well with kind of the modern American home buyer looking to find loan options that suit them. And I guess on a qualitative level, I guess you could offer some statistics, but on a qualitative level, just kind of what you've seen here recently with the non-QM space. If you could corroborate my newfound fandom a little bit, that'll make me feel good.
Well, I'm happy you're aboard the train, Robbie. It took you long enough. No, I'm just kidding. You're not uncommon, frankly. It's when we started this back in 2013, actually before the QM designation had officially come about. That was like the spring or January, February 2014. We knew, I've been in the business for over 25 years and kind of always been in the more of the non-agency space. It had a different term before the Great Financial Crisis, but after the Great Financial Crisis, the pendulum went from fog and mirror loans to could only qualify for agency or government loans. Those were the only loans available. I mean, even prime jumbo went away. So we just believed, back in 2011, that there's always going to be borrowers that don't fit the tight agency and government boxes. There's just always going to be, and whatever the government does and whatever happens with conservatorship and all that, it really doesn't matter. They're always going to have their guidelines that are going to leave a lot of qualified home buyers out of the market. And so that's really what we've been on, kind of a mission since 2013, is just educating originators. When QM non-QM came out at the very beginning, we had to start at the basics. Originators for a period of time weren't sure if it was illegal to originate a non-QM loan. They thought every loan had to be QM. That's why the rule came out. When in fact that wasn't the case. But that's the mindset that we were having to deal with. But what's especially the last few years, after rates have increased and the refi business just evaporated, more and more originators turned to non-QM and have said, I'd like to learn about this. I always heard about it, but I was so busy doing my agency purchase and refis that I just didn't have time to pay attention to non-QM. And during that period, we just said, hey, might as well know a little, enough about it that if it comes across your desk, you're not going to have to refer that out. You can actually originate those loans. But again, when someone's so busy, they just kind of take the low-hanging fruit and keep moving, which makes total sense. In the last 3 years, people have gotten to know non-QM and learn about it and realize that it's really filling a need that is in the market, that, again, qualified borrowers, but they just aren't going to fit those tight agency guidelines. And that's what we're still doing today. And the way the economy is moving and the gig economy and how easy it is to become self-employed. You can do that virtually within an hour. You put all that together, and non-QM is filling a need in the marketplace.
Yes, and I would argue that the industry right now could use some innovation. And I don't know if non-QM quite qualified as innovation. It kind of spawned out of Dodd-Frank, out of necessity. But now we've seen, with a lot of capital interested in the space, there's borrower demand, there's investor demand, all those sorts of things. It's ready to kind of innovate and proliferate. And so I will ask you, in the least cynical way, where are some spots you could see the non-QM space innovating and helping push the mortgage market, mortgage ecosystem forward currently?
Well, I'd say first and foremost, and this, when we started this at Angel Oak, it was our mission has always been to originate good loans to qualified borrowers. That is something that we've never lost sight of. And frankly, leading up to the great financial crisis, the industry lost sight of that as a whole, not just non-agency, just lending, just lots of reasons. No need to rehash all that, but that's where we start. We start with, who are the borrowers that are not being served that are good qualified borrowers? And so there's no magic bullet out there. I really feel like the core products with a non-QM, specifically the bank statement loan for self-employed borrowers and the DSCR loan for professional investors, those are big buckets. Those are lots and lots of qualified borrowers and potential homeowners that fall into those categories. So the innovation, I don't see anything right around the corner that, gosh, when this comes out, non-QM is really going to take off, because we still have to abide by the Dodd-Frank and documented ability to repay and things like that. So, which is really good. We've got, the industry has the guardrails, so we have to stay within those confines, and that's good. That keeps everybody playing nicely, and it kind of forces everyone to start with, these have to be good performing loans. Some of the challenges as a lender in the non-QM space is there's still every single loan, at least the ones that are going into securitizations, which is the vast majority of them, every single one of them goes through a third-party review of the collateral, and that's time consuming. It's costly. I think it's a little overkill at this point, and made sense in 2014 and 15 and before the securitization market. But now we've got 10 years of performance history that has really shown that the non-QM space produces good performing loans to well qualified borrowers.
Well, I think that there's some relief here that's happened recently with the Fed cutting rates. That's kind of spurred the general public's interest in, hey, is it a good time to get off the fence and to get back in the mortgage shopping game? And that can only benefit the non-QM space. But I want to ask you, with potentially easier monetary policy ahead here, what does that mean for the yield curve and kind of the demand for non-QM or various products? We've seen a rise in HELOC. We've seen ARM demand rise. What do you portend for the future when it comes to a little easier monetary policy with some of these non-conventional products?
Well, the non-QM is always going to be a subset of just overall mortgage activity and origination. So if the set gets bigger, the subset's going to get bigger, right?
Yeah.
So we think of non-QM as give or take 10% of the origination market. So if the origination market goes up significantly, non-QM will be right there. I think one of the differences now is that over this last 3 years with the higher for longer interest rate environment, more originators have come to learn about non-QM, originate non-QM, and then realize that these are not difficult loans. I think that was the whole reason back when people's desks were full of loans and full of refis, that they didn't want to do that non-QM loan because they were a little afraid that it was going to be too hard to originate. And there's a lot logic behind that. When you think about a bank statement loan, you're like, oh my gosh, gathering bank statements and making calculations and blah, doing all that work. But what they come to find out is that getting 12 or 24 months bank statements is kind of easier than getting tax returns and having to make sense of a self-employed borrower's tax returns. That's really kind of the good news for non-QM is the number of originators that in the last couple of years have gone through and closed non-QM loans. Maybe they're first, but once they've done it, the feedback we get from our customers and our partners is that, hey, thank you so much. We want to go find more of these borrowers. We love this process. We have lots of originators that say they cringe at a full doc loan. They would much rather have a bank statement self-employed borrower because of the ease at which those loans can be originated. And, that's just kind of a testament to experience in the space. And, we at Angel Oak were just always aiming to make the processor faster, smoother, more reliable, everything that we can do to make it easier on the originator and then ultimately the borrowers and home buyers.
Yes, and I would say that in general, this is a great time for originators out there to assess their service offerings or kind of reevaluate their service offerings as they try and serve the broadest range of consumers, if that fits into their target or what they're going for. What are some of the best ways for companies to evaluate or reevaluate their service offerings, either now or on an annual basis?
Well, I think a lot of it, we've had a lot of turnover in the origination side, and what we've seen is a lot of our customers that have done a loan at ABC Mortgage, they moved to XYZ Mortgage, and part of them moving is a requirement that the company signs up and does business with Angel Oak because they want to keep originating these non-QM loans. So I think it's just kind of the tentacles of non-QM have just spread really organically as much as anything. And there's been, a lot more lenders have who were always just agency lenders. They've started originating non-QM loans. So I think it's just, I think I saw a stat recently that over 10% of the applications, I believe it was in July, of new mortgage applications for non-QM loan applications. So, that's kind of hitting what I mentioned earlier. We feel like that's where the market should be, but that's the first time we've seen the applications actually get to the capacity or the need and the demand of non-QM.
Yes, and I would add to kind of best ways for originators to get the word out to their clientele that they do have these various offerings, whether it's bank statement loans, maybe it's a HELOC product. I think that it's incumbent upon these trusted professionals in working with borrowers to say, hey, we have these products. What's the best way to kind of get the word out in the public consciousness of what exactly is out there that can fit your borrowing needs?
Well, I think, we've seen a lot of originators have success when they actually position themselves as a non-QM expert, because everyone knows and expects a licensed originator to be able to originate an agency loan, right? Everybody's done it. Everybody can do it. So the people that are really taking non-QM and putting themselves out there as, hey, yes, I can do your run-of-the-mill agency or government loan, but if you are a self-employed borrower and you've had a difficult time qualifying for a mortgage, or you have an accountant that does their job and takes advantage of the tax code and all that, but that doesn't necessarily reflect your ability to repay a mortgage, I'm your guy. Let me, I'm the bank statement, or I'm the self-employed expert, or you're a professional investor. I'm an expert in these investor loans. And so people that kind of build their reputation and their brand around non-QM, it makes them different in the market, stand out from the crowd. Again, people make the assumption, rightly so, that anybody can do this right down the middle loan for me. If I'm a W-2 borrower and I've got good credit and good assets, I don't need a specialist. Anyone can do those. But to be a specialist in non-QM really kind of sets you apart from the pack.
Your PR folks originally reached out to me under the pretense of, let's talk about interest rates and the Fed and those sorts of things as it pertains to what you're seeing at Angel Oak. And I'll let you pull out your crystal ball here a little bit as we see what is hoped to be kind of a reduction in rates throughout the end of the year. And there's no guarantees there. Actually, I think the 10-year Treasury yield is up since the Fed cut. And some of the investor expectations have gotten some cold water doused on them. But what do you see as we move through the end of the year and into 2026 in terms of the interest rate environment and kind of generally speaking, the overall lending environment as well?
I mean, I do believe that the Fed is going to ease their policies. They've said it, that they plan to. I think it's extremely hard to predict at what level. I believe Powell was speaking today, and there was a lot of people talking about, is this from last week's rate cut, there were going to be two more for the remainder of the year. But what I'm already hearing about it is that today's discussions are about, well, we got to keep looking at the data, and the data will tell us this and will tell us that. So I don't think we can count on just continual easing, but I think just a more of an easing mindset is going to be good for everybody in the real estate industry. The real estate has become pretty stagnant just in general. We have all these people locked into these ultra low rates, and they're not going to, the rates aren't going to decline to where all of a sudden they're going to be in a better position from an interest rate perspective. Housing affordability is still a factor and it's still a challenge. But I do think people feel better knowing that there's an easing policy in place, and that I believe that's just going to continue to encourage, and we're going to see more activity, more transactions, more people saying, okay, I've been in this house for 5 years and it's time for me to move on, or I've been holding off for the last 3 years to do this, or I've been holding off, even at the ease of the interest rates. You mentioned HELOCs. HELOCs are an extremely popular product, and we have a bank statement HELOC even for the self-employed borrower, and those rates went down as soon as the Fed eased their rates. So people that have been putting off maybe doing a renovation or an update to their home, but they're sitting on lots and lots of equity, now is a great time for them to tap into this, and the rate that they'll be paying will fluctuate down as the Fed continues to ease their interest rate. So, I think there's lots of lots of optimism, looking into the short and midterm future of the mortgage business, and so we're really excited about where things are headed.
I'm excited too. Let's hope all this comes to fruition. And I would say it's about dang time. We got some movement out there. So I appreciate you bringing some expertise to the podcast. It's always a pleasure talking to you, and hopefully we'll have you back on soon.
Great talking to you, Robbie. Appreciate it.
Fed-favorite core personal consumption expenditure price index for August kicked off today's calendar, up 0.3% month over month as expected. Core PCE was up 0.2% as expected, and for the year was up 2.9%. Also as expected. Personal income and spending came in up 0.4% and 0.6%, up 0.6% respectively, about as expected. Later today brings final September Michigan sentiment and remarks from Richmond Fed President Barkin and Vice Chair for Supervision Bowman. After the latest inflation data, Friday has agency MBS prices roughly unchanged from Thursday, the 2-year yielding 3.64 and the 10-year yielding 4.16 after closing yesterday at 4.17%. Let's wrap up with a joke and some housekeeping. A little boy opened the big and old family Bible with fascination, looking at the old pages as he turned them. Then something fell out of the Bible. He picked it up and looked at it closely. It was an old leaf from a tree that had been pressed in between the pages. "Mama, look what I found," the boy called out. "What have you got there, dear?" his mother asked. With astonishment in the young boy's voice, he answered, "It's Adam's suit." Thanks again to Be Smarty for sponsoring this week's podcast. It's the most innovative mortgage technology platform for banks, credit unions, and non-bank lenders. To learn more, visit besmarty.com.